Good afternoon and welcome to our latest webinar, Understanding the Latest Tax Treaty Developments. This is the second part of a two-part series that we held the first part of earlier this year. I'm Helen Smith and I'm from HLB, and I will be joined by a panel of speakers including Christian Jandorf from HLB Germany, Zech from HLB Germany, Surabhi Bansal from HLB India, Aaron from HLB USA, and Nick Farmer from HLB UK, and they will both be joining us for discussions later in the presentation. I'd like to hand over for a summary to Christian Jandorf.
Thank you, Helen, for your introduction. That we need two parts in order to cover the whole topic shows how important it is. Today we will start with a short summary of the first part, and then today we mainly focus on the MLI, which is presented by Till, and on the specific impacts of the MLI in India, but more than that, it's more an Indian update on the latest developments there. So let's start with a summary. We discussed briefly the process of restructuring the treaty network that started about 10 years ago, when under the leadership of the OECD, the states formulated ideas about anti-tax base erosion and profit shifting, which has been later named as BEPS or anti-BEPS actions. The objective is clearly focused on the avoidance of aggressive tax structures. We also focused in the first part the importance of treaty interpretation. If double tax treaties are interpreted differently by the states, double taxation or even double non-taxation may occur. In this context, we discussed some classical problems such as the interpretation of beneficial owner or the differentiation between service and royalties. From the US perspective, Aaron gave us some US insights, and one remarkable highlight was that in March 2021, YouTube indicated that they would start withholding tax income earned by, or withholding tax of 30% on income earned by foreign persons. The withholding applies to earnings from viewers in the US from ad views, YouTube Premium, Super Chat, and so on. And Aaron explained to us that this is a significant change in US tax policy. This also triggers the aforementioned treaty topic, royalties versus service, for example. From the UK perspective, Nick Farmer gave us insight on the Brexit impact on tax treaties, and he gave us a case study. A case study on what Corona would do with our home offices, and the core question was: does a home office create permanent establishment when we use it in because of Corona lockdown? And the OECD gave us some guidance lately on this topic, and Nick could draw the conclusion that we can give all clear as long as the physical presence in the home office is the consequence of the lockdown. One recommendation was to file proper documentation. I would like now to hand over to Till, one of the main topics of today, and Till will deal with the MLI, and this is a really important change in treaty politics today, namely the restructuring of the treaty network. And today we can distinguish between pre-BEPS treaties and post-BEPS treaties. And in order to ensure correspondingly rapid applicability, the OECD has additionally developed the MLI, which Till will explain us now. So, Till, I'm happy that I can hand over this topic to you. Go ahead.
Thank you, Christian, for your introduction. And I hope that I am now the master of the slides. Yeah, okay. So the MLI, the multilateral instrument, is a very important tool now in international taxation. And today we speak about the relevance, about the practical application and some practical experiences. And to understand the subject, we have to have a short look on BEPS. Christian just introduced the BEPS project already. And here you can see again the BEPS project consisted of 15 different actions. In this scheme, I framed 13 of these 15 action points by saying that action 1, addressing the tax challenges of the digital economy, was the overall topic. And then came 13 different topics, with the main topics: coherence, substance, and transparency. And then came up the big question: how can we implement BEPS into all the tax treaties which exist worldwide? We have over 200 countries in this world. We have estimated 3,600 double tax treaties, and it would take a very long time to renegotiate all tax treaties which existed already in 2015 when BEPS was finally negotiated. So the politicians who wanted to start with the BEPS project asked the OECD to find a solution how to create an instrument which enables the state to go immediately ahead with all these propositions which was made by the BEPS project. And then came a very new invention, and this was the Action 15. This was the idea of creating a multilateral instrument which could modify all the bilateral tax treaties at once. This was really a revolution in tax treaty law. And when BEPS started in 2013, nobody had an idea how the MLI could work. And within 2 years, the OECD was able to present an action plan on this. This was really a great performance. And if you know now that the MLI is a consequence of the BEPS project, and if you know the background, then you understand here the first bullet point, the nature. The MLI is a multilateral international treaty that allows many bilateral tax treaties to be amended, and now it comes in a single step. How this works, I will explain on the next slides. But that this is possible in a single step, this is the really revolution. So the sense and the purpose of the MLI was to ensure the quick and rapid implementation of the key recommendations of the tax project in the already existing double tax treaties. That was the point. If a country negotiates now double tax treaties after the MLI, it is able to include all the rules of the BEPS in a new tax treaty. But the interesting thing is what to do with all the older tax treaties. And for these, the MLI is very important. So how is the legal relationship now between these older double tax treaties and the MLI? And here you can see that you have to use both. You have to use the unaltered double tax agreement or double tax treaty, and you have to see the modifications made by the MLI, and these two together, they lead to the adjusted legislation which is now in force, and that makes it pretty complicated. If you have now an international case, a cross-border case, and if you have a double tax treaty or double tax agreement, you have first to look into this double tax agreement, and in addition, you have to see whether the MLI is applicable to this double tax treaty, and if it is so, then you have to see how much did the MLI modify this double tax treaty, and then you know what the existing legislation is. So I took out an example between Austria and Poland, because Austria and Poland were under the first states which ratified the MLI. You can see here, in the meantime, 95 states have signed an agreement to implement the MLI, and 64 have already ratified it. This was the status end of March of this year. So the first step is always to look whether your country is involved. So Americans could say now, well, the US did not sign the MLI yet, so the whole subject is not interesting, and Aaron could go back to bed and say, let's discuss them. It's not interesting for me. But if you are the counselor of a multinational enterprise, and if your company, for example, an American multinational corporation, has subsidiaries in Poland and in Austria, and you have relations between these two countries, then you have also to look up whether the MLI might alter the double tax treaty between Austria and Poland. So even if your country is not a member of the MLI yet, you have to know about this multilateral instrument. And what do you have then in a concrete case to do? You have to see whether the concerned countries, here for example Austria, notified the OECD that it wanted to join the MLI, and Austria was under the first 35 states who notified that it wanted to participate, and it also wrote in that notification that 35 of the Austrian double tax treaties should become so-called covered tax agreements. Covered tax agreements means that we have here a double tax treaty which is covered by the MLI. And then this country had to deposit the instruments of ratification within the to the OECD. And under the first 5 countries who did so were Austria and Poland. So the MLI itself could entry into force on the 1st of July of 2018. And later, one country after the other stepped by and ratified the MLI. For example, Germany did this also in the meanwhile. So when you know now that both countries which are involved in your case, country A and B, in my example, Austria and Poland, are both part of the MLI, then you know, okay, now I have to see whether the double tax treaty between Poland and Austria is altered by the MLI. So how do I find out whether both countries take part in the MLI? The OECD has a database, and you can look it up in this database. It's public. Everybody can have a look at it. And here you can see, for example, that the Poland-Austria tax treaty is part of the MLI. And in addition, and this is also the next important step, you have to look up whether each country wants to match the other country within the process of being a part of MLI. In one of the HLB seminars, I described this one time as a kissing process. What do I mean? I mean, when Poland made the notifications, they had to address which countries should be part of their MLI concept. Well, when they said Austria should be a part, then it is only the first step that Poland said, I want to kiss Austria. But it does not say that Austria wants to be kissed by Poland. So this match does only work if Austria also says, I want to notify that the Austrian-Poland tax treaty should be covered by the MLI. So only if both countries say that we want to have this double tax treaty covered by the MLI, then we have a covered tax agreement. And here Poland and Austria both did so. So this double tax agreement is a covered tax agreement under the MLI. So in my example, I know now I have to have a look on the MLI. And here on this slide, you can see how the link works if you go to the OECD website. Yeah, they call it MLI Covered Tax Agreements Tracker, and it is always up to date, so you can look it up in real time. So BEPS, not MLI. BEPS had for minimum standards, which they asked should be in every tax treaty, and they wanted that the member states of the OECD implement measurements against these or for these projects. This was countering harmful tax practices, treaty shopping, the transfer pricing documentation, and dispute resolution. And the MLI said also for minimum standards, which are not totally the same, but they are close to this. You see, the MLI contains provisions about the purpose of a covered tax agreement. The MLI contains a prevention of tax treaty abuse. It wants to have a mutual agreement procedure, and it contains corresponding adjustments. So if somebody, or if a member state notifies that it wants to implement the MLI, then it also signs these strict implementation standards. Now, what happens, and this is now an example, if I have a case which does not fall under these minimum standards? A very good example are rules about the avoidance of permanent establishment. They are in the Article 12 to 15 in the MLI, and everybody probably understands the relevance of permanent establishment rules. And in the past, there was a lot of abuse. Many MNEs tried to avoid permanent establishments, and the aim of the states were to prevent the abuse of rules and to prevent the avoidance of permanent establishment status. So the MLI had some special provisions for this. Now the question is, if you have a case like the Polish case, do these rules apply or not? And what makes it even a little bit more complicated is, before you look now on these Article 12 to 15, you have to have in mind that the MLI use different terms how the MLI alters the double tax treaties. Some of the rules, also in Article 12 to 15, have a rule that they say it applies to something of the double tax treaty, so there is only a modification. Sometimes they use the phrase in place or only in the absence form, and sometimes the term is used in place of. So you have to see in every article what special rules have to be applied. That makes it more complicated. So if you sit now in front of your desk and if you have a case, what questions should you ask yourself? And therefore, I made here a little checklist. First, you should ask, what topic are you looking for? I took here now the example of permanent establishment. What subtopics do you research for? Let's take the example of a definition of a representative permanent establishment. This would be Article 12. So if you have such a case of a representative permanent establishment, you have to see whether Article 12 and then MLI might apply. Then, third step, did my country, which is involved, make a reservation to Article 12? Reservation means that it said by the notification, I do not want that this article is applicable under the MLI if I use this double tax treaty. For example, if Austria would have said, well, I want that Poland-Austria double tax agreement is a covered tax agreement, they should, or they could still say, okay, we want the application, but without the application of Article 12. This is a reservation. So if they do such a reservation, then Article 12 does not apply, and only if there's no reservation, then it applies. So, and only if Article 12 applies, then we have to check on the complicated rules of Article 12 in detail. So here you just see an overview of the 4 different articles of the MLI concerning permanent establishments. And we are here only on the left upper side, Article 12. It deals with the artificial avoidance of PE's status through commissioners, arrangements, and similar strategies. Yeah. We do not have time in this short session today to go to all the other articles, but here you can just see an overview of this topic. So, definition of a representative permanent establishment. The implementation is not essential, like I said before, and it is also possible to make a reservation on the whole article, or I have to accept everything. So I cannot accept part. This is stated in Article 12 of the MLI. An dependent representative can also establish a permanent establishment without having a power of attorney. This is a new rule. This was a big discussion under BEPS. It was always a question, should legal or economic approach should be chosen? Germany was one of the countries who voted for economic approach, and they won. And therefore, it is not necessary anymore that you have really a power of attorney to create a permanent establishment, but it is sufficient if they assume the essential role in concluding a contract. Now, at least as long as there are no material changes made by the principal. So this is a very new rule in permanent establishment law, and this is applicable now if Article 12 MLI applies. And persons who work almost exclusively for one or more affiliated companies cannot be independent representatives. So this is also new. It is if somebody works more or less for one party, he is treated like a dependent person. So, having said this, how do we apply this now on our example, the Australia-Poland double tax treaty? So, here we see again the main points: the extension of the final power of concluded contracts, the independence in group affiliation, like before, and the third point, which is not important for us now, is the separate consideration of different business activities. They all are applicable now if both countries did not make a reservation on Article 12. Now let's see. Here you can see this is an original picture from the OECD, and I showed you here the internet link, so you can look by yourself. And if you call up the MLI database, you see a matrix of options and reservations. And here you can see the Austria link, and you can see which of the articles of the MLI are applicable or not by checking to which articles Austria made a reservation or not. So here you can see in our example that you have to go to the national notifications in this database. And there you can see first that the MLI has been ratified. And you can also see here the double tax agreement became a cover tax agreement. So far, we are on a good way. Now, what is about Article 12? And now, you see here between Austria and Poland, and here you see Article 12 would not apply because one of the countries made a reservation to Article 12. So you can go to the database and you go step by step. And finally, you see, okay, applicable in general because covered tax agreement, but reservations to this article, so it does not apply. So here you see it again on the left side. I don't know whether you see my mouse. It does not apply. Both states have chosen the option of opting out. Yeah. Article 12 again says you can accept the whole article or you opt out totally. Here, Poland and Austria opted out. So the MLI alter the double tax agreement, but not concerning Article 12. So the result is that the double tax treaty is applicable in this point without application of Article 12. Yeah, here you see it again from Austria and Poland, just in another way. So you have to go by yourself or one of your people or your colleagues have always to check the OECD matching database. So the result I presented already, the double tax treaty relations of a permanent establishment apply so far unaltered. Here you see another overview. This is also from the OECD. It might help you if you go here on this website. There you see a scheme. You have always to see, or you can start like this. Does either party make a reservation under Article 12, paragraph 4? If one of the parties made a reservation, then it does not apply. If no party made a reservation, then at least you can go further. Then you have to look up under Article 12, paragraph 1, do all parties notify the same provisions under Article 12, paragraph 5? If yes, then Article 12.1 applies with respect to that special provision. And if not, then Article 12, paragraph 1 does not apply. Or if both parties say no, then Article 12, paragraph 2 applies. And then you ask, do all parties notify the same provisions under Article 12.6? If they do both, then Article 12, paragraph 2 applies. And if not, Article 12, paragraph 2 does not apply. So it is quite a complicated and long procedure. But I must admit, I would not have a better idea how to work with this. I mean, for us as tax specialists is perhaps an advantage because our clients need us. But in addition, I do not see any better approach how we should deal with this general idea. Finally, what happens if we have another example, a positive example? And for this, I took the example of the Norway-Netherlands double tax agreement, because here they did not make an reservation to Article 12. So in general, Article 12 applies to these countries. And therefore, it is so because there are no reservations. Article 12 does apply, That means it is important to see whether it is not decisive anymore whether the representative has a power of attorney or not. This is not anymore a condition. Important is the economic approach, the business approach. What did the representative do? And if he worked in favor of the principle, then he created a permanent establishment. So therefore, the signature by the representative is not longer obligatory. It is enough if he negotiates all essential elements of the contract. So the summary is, it is enough if the representative has the key role in concluding and negotiating the contract. And this is true, this is available and applicable now to the Norway-Netherlands double tax. So what we have seen now in this half hour is how the MLI generally works, how we have to look all the time now if we have a double tax treaty, whether this double tax treaty is influenced by the MLI or not. And now Surabhi will give us an impact how the MLI influences the double tax treaty system in India and how the Indian side on the MLI is. Surabhi, please. I cannot go more further. I'm sorry. I'm not anymore the master.
Thank you, Till, for the wonderful presentation. Helen, am I the presenter now?
Yes, you are, Surabhi. I've just handed it over to you.
Sure. Yes, okay, thank you. So, greetings from India. And I'll be taking up few important changes that have been done recently in India regarding this international taxation. So often we find that people from all over the world, they find India tax policies a little different. And to understand that, I think what we need to understand is the economics of that particular country. So I'll just give you a brief background and then we'll jump onto the slides. So as you know, that world is divided into COS and core countries. COS, I mean the country of source, and core is the country of residence. Okay, so India is primarily, it can be classified as country of source, and it has taken a long-standing position that the source-based taxation should be advocated. So it's not a member of OECD, but it follows the UN model for the purpose of tax treaties, etc. I'll give you one very good example of the difference between OECD and UN model. So the royalties, if we see these, they are taxable in the country of residence only in OECD model. Whereas UN model, which advocates source-based taxation, it gives right to the source country as well to tax the royalties. So there are few more such differences between OECD and UN model. Like in UN model, they have service PE, which is not there in OECD model. So with this background, I'll then come to the BEPS and what changes have been done by India. So as rightly mentioned by Till, that this BEPS is one of the most ambitious project of the recent times and wonderfully handled by the teams within a span of very few years. All the guidelines, all the recommendations have been already in place. So what is pending is the resolution to action plan 1. So few recommendations have already been given, but there is no consensus as on date. And hopefully there is a possibility that by the mid of this year, maybe October, we'll see something from OECD and G20 framework on this digital economy issue, which is addressed in Action Plan 1. So India has taken few unilateral measures, okay, and what are those measures? I'll just discuss that in this slide. So a levy known as Equalisation Levy that has been made applicable from 1st April 2020. So what this levy aims, it is to basically tax the digital transactions undertaken by the foreign e-com companies. So now foreign e-com companies could be for India like Google, Facebook, Amazon, and a lot more. Okay. So e-com operator has been defined as any non-resident owning, operating, or managing a digital or electronic facility or a platform. Okay. Now, what this levy says, it says that the levy would be applicable if a transaction, online transaction has been made by a non-resident e-com operator with a person resident in India. Okay, so that is one. And second is also that if a transaction is made between two non-residents, even then it can be taxed in India. Okay, so when what would be the cases when a transaction between a non-resident and another non-resident can be taxed in India? So we'll take one example for like Facebook. Facebook, they give some advertisements over the platform, which is basically to target the Indian customer. So if a non-resident company is paying some money to Facebook to showcase that advertisement, even that would be taxed in India. Okay. Secondly, if there is some database like Google, they keep on collecting the data which is of a person who is resident in India, and then it is being sold to the other companies, non-resident companies. Even that data would be considered for the purpose of this levy. So this was the idea of Action Plan 1, and unilaterally India has already adopted this. So now, if we sum up this, so this levy is basically applicable on a non-resident, okay, and who is operating or maintaining a digital platform and making an online sale of services or goods either to a resident in India or to a non-resident in India, wherever the Indian residents are connected to it. And this levy is applicable when the total consideration received by such entity, such non-resident entity, is more than $265,000 a year. So this limit is actually, this threshold is a very low threshold for any big tech company. And also this levy would be directly payable by the non-resident. All the return filings, everything is to be done by the e-commerce non-resident e-commerce operator. I think okay, some change in the slide I can see. Yeah, okay. And so see, another important thing about this levy is that this levy is not as per the DTAA. So this is not part of the income tax, and therefore the non-resident would not be able to claim any benefit of DTAA on this levy. So this is something unilateral, and it is applicable on non-resident, payable at the rate of 2% of the consideration received by the non-resident operators. So what is important here, because this levy is already applicable from 1st of April 2020, that the non-residents who are working, who are operating in India through the digital means, they should reconsider, they should just go through the entire position and evaluate whether this levy is payable by them. So this was one change. So one more important thing on this levy, there is already a US trade representative has called this levy as discriminatory and unilateral. So between US and India, some exchange of these is going on, views. Exchange of views is already going on between the two countries. So another important change with respect to this action plan 1, that again is a unilateral change that has been done in India, is that they have introduced the significant economic presence in India. Okay, so we do have a definition in DTAAs of permanent establishment, but this definition is different from those which are already contained in because we generally require a physical nexus. What this significant economic presence says, it says that it should be an economic presence. Economic presence, what is economic? It has been defined. And if it is significant, if that economic presence is significant, it will be presumed to have a permanent establishment in India, a business connection in India. Okay. Now the question would arise, of course, that when there is a treaty and treaty does not support this significant economic presence, then yes, as of now, the position in treaty will prevail and the domestic act will not. But where the treaty is not in existence, or where the treaty has been, because of this treaty abuse, the benefit have been denied to the non-resident, there these provisions will trigger. Another important thing in this is that UN committee has already come up with Article 12B, which talks about the significant economic presence, and India proposes to renegotiate the bilateral treaties based on this 12B article of UN model. So I think I jumped on to one thing, that what is significant economic presence. I'll just come to that. So where the transaction in respect of any goods, services or property, if the aggregate payment is exceeding $265,000, or otherwise, the second condition is that the systematic and continuous soliciting of business activities where the number of users exceeds 300,000. So India's population is 1.38 billion, and here the 300,000 is no number as such. So for any tech, tech giant, if we talk about, so it will create a significant economic presence in India. But the good part is that as of now, this is only contained in domestic law. And yet to be implemented by way of maybe 12B or something. So treaty countries, the non-resident in treaty countries would not be hit by this SEP, but yes, they would be hit by the equalization levy, which we just discussed in the previous slide. Now coming to the MLI. So these were the two important changes I just wanted to mention before we come to MLI. So as far as MLI update in India is concerned, India has deposited the ratification instrument in 2019 June, and we have total 95 treaties, and out of 95, excluding the two, that is China and Marshall Islands, remaining all have been classified as CTAs, that is covered tax agreements. But there are few that have been already ratified by the other partners as well. For example, like Australia, France, Japan, New Zealand, Russia, Singapore, UK, UAE. So these are the ones with whom already MLI is applicable, it is in place. And as Till mentioned, that it is like a marriage, that when both it's a matchmaking, when both the parties agree, only then the marriage will take place. So it is similar to that. So here important to note that Germany, Switzerland, Mauritius, they have not classified India as the CTAs. So the original treaty will continue. The DTAA, which was already in existence, will continue. US has not yet signed the MLI, and with China, separate negotiations are going on holistically for the complete treaty, not only for MLI. The key impact areas, see, total 4 action plans have been covered for the purpose of MLI. So India, as I mentioned, it is a source, advocate source-based taxation. So majorly all the clauses wherein the source is expanding, that has been adopted by India. So we'll go quickly one by one. I mean, it will not take much of the time. So in Action Plan 6, that is preventing treaty abuse. So India has opted for the new preamble, which is again a minimum standard, and principal purpose test. So India has also adopted for SLOB, but there are very few countries who have adopted for SLOB. So it seems that it will not be applicable. For concessional dividend rate, 365 days have been agreed upon. For taxation of capital gains also, the 50% of the value which is to be principally derived from immovable property, that has been agreed to. And earlier in domestic act, we were having, instead of the immovable property, it was 50% of the assets. So now it will be changed to 50. I mean, in wherever MLI is in existence, it will be only 50% of the immovable property. For PE, all the three these arrangements like commissioner arrangements and preparatory and auxiliary to be excluded, splitting up of the contracts. India is party to all these. They have agreed to align with these provisions. What is important here is only one thing, that in 2017 update, OECD update, India has given certain reservations. And I think whenever we are discussing PE with respect to India, it would be important to take note of those reservations which have been given for OECD commentary. Other than this, Action Plan 2, hybrid mismatches, because partnerships and AOPs, they are already taxed at entity level and they are not treated as transparent entities. Probably that is the reason that India has given the reservation for Article 3. For tiebreaker test, yes, for these competent authorities would now be the deciding party for dual residency other than for individuals. And regarding the credit method and exemption method, India has always been applying the credit method, and it was with only few countries that exemption method was there. And with the ratification of this MLI, even there the credit method would now prevail. Last important thing is the with regard to dispute resolution. So see, this is again a minimum standard, and India has not allowed the taxpayer to approach the competent authority of the other state, which is provided in MLI. But what India has done, they have agreed for bilateral negotiation and consultation process, and they have also come up with very detailed guidelines wherein the assurance has been given to the taxpayer that within 2 years the MAP proceedings would be completed. And for arbitration clause, India has not agreed for the mandatory arbitration clause. So these were the points, I think, which were important from MLI perspective. And just few examples I've quoted here, like again, just as an example of matchmaking. So major treaties we have put up here, like France, UK, Netherlands, and Singapore. So with France, if we see like PPT and this SLOB clause, so only all these 4 countries, they have only opted for PPT. They have not opted for SLOB clause. So SLOB would not be applicable. It would only the PPT clause would be applicable with all the 4 partners, treaty partners. And here it is important that asymmetric application of SLOB is also permissible by MLI. So the Greece is the only one country who has accepted this, that asymmetric application of SLOB can happen. So that is the only exception. Now coming to, I'll be just winding up in next 1 or 2 minutes. Next is like these agency rules. Again, for these agency rules, we have just taken up a few examples. Like commissioner agreements, it has only the France which has notified the same. So it will be applicable only with France, not with UK, Netherlands, Singapore, and all. Splitting of contracts, only Netherlands has opted for it. So it is like that we have to go and see for each treaty what has been done. India's position in the previous slide I have explained. that what India has opted for. I think with this, I'll just hand, because very few minutes left for the questions. I'll hand over to Helen. Thank you.
Thank you, Surabhi. Okay. Great. There's some very interesting points there. Can I bring in the rest of the panelists for discussion? Is there anything you would like to raise or particularly highlight from all of that?
I can mention from a UK perspective some of the points that sort of arise from that discussion. Relevant to note, I think the UK does have a very wide treaty network, probably about 130 treaties, and full coverage with the EU 27. In the UK, we've typically seen that the tax treaties have been updated by the tax authority here. So on the face of them, we're now starting to see the changes that have been made from the respective clauses of the multilateral instrument. So rather than necessarily having to go to a separate database, we're now starting to see those changes actually reflected in the treaty themselves. And perhaps one sort of quite interesting development, I guess, that we've also seen with Germany, and Chris and Till might just want to comment on this, that there's a separate protocol going into place, which is actually bringing in some of the PE fragmentation provisions that were mentioned there. So rather than, again, having to go to a separate database, we're now seeing them actually reflected in an agreement between the parties. Finally, just picking up on a few points Surabhi made, India's introducing a digital service tax. UK has one as well. So similar in terms of the time it was introduced, April 2020, and the rate here in the UK is at 2%. We have higher thresholds though. Surabhi mentioned a very low threshold there in India. The UK threshold is at 25 million, and that's revenues from UK users. If a group of companies has global sales of more than 500 million, and it's particularly applying to businesses that provide social media, search engines, online marketplaces. So that changes in, and the UK have always said that if agreement comes from the G7, that this unilateral measure will be withdrawn once there is sort of agreement as to how a sort of a wider digital service tax can be introduced. And of course that's very topical given the recent G7 discussions that took place in the UK. So there's a few comments from the UK. Maybe Aaron, I'll just pass over to you from a US perspective.
Sure, thanks, Nick. Well, from the US side, obviously US hasn't subscribed to the MLI, so we kind of watch it from afar and see what's going on in the other countries. Really appreciated Till's illustrations of the database, and I think that's just a really great reminder from a US tax standpoint. You know, we typically rely on those tax treaties quite heavily, and looking at those, and just to, you know, keep in mind that as we're looking at treaties between two countries that might not be between the US and a foreign country, but maybe a US company has two subsidiaries and they have transactions, and we need to evaluate the treaty between those two countries or those two subsidiaries, that the MLI is definitely relevant and something. It's kind of an additional step in the analysis to determine what the tax implications would be. So yeah, I think it's a really timely discussion, given that, Nick, as you mentioned, with the G7 and just all the activity that's happening worldwide for tax reform in general. I think it's just going to be really interesting to see how that kind of shapes out, not only with maybe like a global minimum tax, but also with the digital services taxes. And ultimately, at the end of the day, where is that going to land, and what's that going to mean for companies in, you know, various jurisdictions?
Yeah, I think the key point there, Aaron, is that the MLI is obviously coordinated, which is, as Till said, very impressive that the OECD have been able to bring that approach through and you know, end up with this outcome. Whereas we are also seeing these unilateral taxes now. So not only does the UK have a digital service tax, we have a diverted profits tax, which is purely unilateral. It overrides tax treaties and foreign businesses selling into the UK. If they're seen to be sort of diverting profit out from the UK, they can get caught here by that tax. There's no treaty protection from it, and actually the rate is going to be quite penal. From 2023, that rate is going up to 31%, which is above the main rate of corporation at that time, which will be 25%. So I think that's a very relevant point, that although there has been some coordination, there's still between tax authorities a lot of unilateral action being taken, especially around sort of the digital space, and that leads to a lot of uncertainty for businesses. So you know, there's a lot to be done there, and hopefully we will see some coordination come out of the recent G7 discussion. Chris, maybe I'll hand back to you.
Yes, now I found the button to switch on the mic. Thank you. But I'm impressed that UK and India are, from the German point of view, ahead of their time, or at least ahead of our time. The thing like the digital service tax we do not have. I think it's a relevant instrument to have, let's say, also a fair taxation. One point that I was astounded a little bit is that it's not qualified as an income tax. So it's outside the treaty protection. I wonder if this is, let's say, in the perspective of a fair taxation, a right approach to deal with this sort of service. And you are also ahead with your consideration on the significant economic presence. So this is also a thing which is under development and does not exist in Germany in such a way it exists in India, for example. So I think Germany will learn a lot from what's happening around the world outside our country. Yeah, so this is just a comment on the impressions that I got from especially Surabhi's presentation. Yeah, maybe let's put a question to Surabhi. Is there a plan to give a relief on this digital service tax apart from treaty protection that we learned is not applicable? Or is it just as a transaction tax, if you have to pay it, it's final, and there's no credit, there's no exemption, and full stop?
See, it seems to be an interim measure. The final thing would be when the 12B article of UN treaty, which I just mentioned. So most likely that is going to be the final word on this, when the treaty would be incorporating this article 12B on automated digital services. It seems to be an interim measure, but yes, as of now, this is what it is. It is a 2% flat levy without granting any tax relief. I don't know whether in UK also, Nick, is it same? Like we do not have, I mean, this is not part of income tax?
What, the digital service tax? We certainly saw that with the diverted profits tax, that it wasn't regarded as an income tax, it's regarded as a separate taxation. I'm not sure how they're treating the digital services tax, but the UK tax authority have definitely in the past shown that they're prepared to take that approach, that they do not regard it as a tax that falls under the tax treaty. And of course then it depends on how the overseas home country may give credit for that. So we've seen that approach before. I'm not quite sure of how the digital service tax is viewed and whether that does fall under the treaty or not.
Are there experiences from the administrative side how to collect these tax? It's a source tax, so it's not the non-resident company which actually pays. It's paid at source by the consumer, or how it is designed.
Okay. See, earlier, so this was levied in two parts. Earlier, there was a 6% levy only on advertisements. Okay, so that was a source-based. I mean, that was through consumer. It was collected. But now the one which is levied now, 2% tax, which is applicable on all sales, etc., including advertisements. So this would be payable directly by the non-resident. Okay, and see, now the question arises why a non-resident would bother even to pay the money. So I think then the business commercial angle come that if the business size is that much, then one will do the compliance and will do the business. So yes, to answer your question, this 2% levy is directly on non-resident, and all the compliance obligations are also with non-resident.
Thank you, Surabhi. Are there any further comments or questions? Take a look at the time. So I may hand over to Helen.
Yes.
You would like to make some final remarks?
I just wanted to say thank you to all of you for the webinar today, and to all of our attendees. If you have any questions, please do get in touch. The recording for this will be available on our website later today or first thing tomorrow, and also the recording is available from the first part of this webinar as well, and in light of the fact that there were lots of discussions in this about digital elements as well, we also held a webinar recently on e-commerce, which is available on our website too. So thank you very much for all of your time today, and we hope to see you at the next webinar. Thank you.
Thank you all.
Bye.
Thanks, everyone.
Bye.
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 Bye-bye.